Welcome to TheoTrade. This is Don Kaufman. It's April 7th, 2018. You are watching the Theo Weekend Update. Let's get started. First of all, where do you really want to begin? This is a fairly manic week that we just saw in the markets. And I have to tell you, a lot of years in trading, but it's kind of a week that, number one, you're glad's over and felt like 5 extraordinarily long days. Kind of a quick recap here. I mean, you're coming in after Easter Sunday to a marketplace on Monday, which none of us really expected anything to happen on Monday because the European markets were effectively closed after the Easter holiday. But we see some wild sell-side activity on Monday. We see an absolutely insane bounce from the pits and depths of Wednesday. So Wednesday, the market early in the morning, diving, and only to see a wild rally later in the day. So you've got like, okay, everybody get out of the boat. By Wednesday, it's everybody get back into the boat. And then coming into Friday, we're looking at like the perfect trifecta, which is, non-farm payrolls. Then you had Jerome Powell, throw a little trade war on top of it. And you got the perfect trifecta, as I said, taking the markets down, specifically the S&P, right down in and around the 2,600. Now, last week I talked extensively about the marketplace, gave you a little bit of a game plan, and the marketplace bouncing between levels. So we're still inside of those very specific S&P levels, which in a few moments I'll show you here inside of the charts. But a few things I wanted to mention before we start digging into the charts, before we really, go into some depth about some specific levels. A few things. Again, a manic week. One of the things that really I think stood out to me throughout the course of this week is that correlations really gripped held of the marketplace. And what that effectively means, when I say like correlations are gripping hold, it didn't matter what individual stock you were in. I mean, if you looked at the marketplace, which again, I'll show you here in a few minutes, you looked at the marketplace on Friday, nowhere to hide. If you looked at the marketplace on Wednesday, whether it was during the sell side activity, whether it was during the buy side activity, everything was moving in lockstep correlation with the greater marketplace. So the correlations throughout the course of this past week were actually in the mid 80%. So what that means is if you looked, for example, at a subset of stocks in the S&P 500, they're moving at a greater rate than about 85% with the S&P 500 itself. Okay, so what does that mean? I mean, again, you'll see here in a moment. If you look at the S&P 100, it was an all-down day on Friday. It means that stocks really are starting to matter less. Okay, so stocks are actually mattering less, and the S&Ps are mattering more and more. So we're looking, again, at kind of a 30,000-foot view of the marketplace, not necessarily like, hey, what do you think this level on Google is going to do? What do you think this level in terms of Amazon happens to be? Where's Baba going to bounce? None of that matters. When correlation grips hold of a marketplace, the only thing you can do, all right, is you can look at the S&Ps, maybe the Nasdaq, and kind of pick and choose those levels, which again, talk about in a bit more depth over here. Now, last but definitely not least, before we do get to the charts, one thing I really want you to think about and consider. Some of us do trade on an intraday basis. I'm one of them. Some of us just trade, we put on some positions for a couple of days, a couple of weeks, we swing trade, right? Well, one of the things that really stands out to me, and this is one that I just can't get over, is that the size of the moves on a day-to-day basis versus the VIX. Okay, and I'll go into some depth about it in a minute, but just think about this. When you're seeing, and for example, yesterday, Friday, you were seeing at one point a 3% move in the S&P 500. Now, that was the absolute bottom. The marketplace closed just south of about 2%, but at one point we had a 3% move in the S&P 500. Then you go and you cruise over at the VIX, and at the time we're getting a 3% move in the S&P. The VIX is like, languishing in the 22, 23 range. Okay, these two don't necessarily make sense. And one of the points I'll make with this is that on an intraday basis, it really makes sense right now to be buying options. On an intraday basis, it makes sense to be buying options. Now, I know what people are going to take away from that. They're going to say, wait, Don said to buy options. Strictly on an intraday basis, because there's such wild movement that the volatility is paying us nicely. Now, that does not mean Okay? And I don't want you to misconstrue this. It doesn't mean that you should be going out there and buying straddles or strangles, because I looked a lot into the mathematics behind, can we buy a straddle strangle for a week? Can we buy a straddle or a strangle for a month and make money? And the answer is absolutely, with unequivocation, no. And one of the problems you have is that if you're buying options, the moment the market starts to rally, they're crushing the volatility out of the calls and the puts so horrifically that you're not going to be able to buy the options. So if I'm telling you that you can't buy the options, should I turn around and should I sell options right now? Quite possibly. And that's exactly what we're going to look at here momentarily. Let's get to the charts. All right, getting to the charts. Let's start with, as I said, a little bit of a manic week inside the S&P 500, and really the entire market for that matter. This is, and happens to be, just set right now to a 1 hour chart, and all I did is just zoomed in. Here's got Monday, Tuesday, Wednesday, Thursday, and Friday. People, look at the ranges that we're throwing off on a day-to-day basis, and this is exactly the point that I not only wanted to make, but I really wanted to start with when looking at the charts. I mean, here's the S&Ps at 2640, dropping out. The low of the week was, again, about 2552. You just really have to kind of grasp this, though. Coming in, again, from Friday to Sunday, you just had a 100-point move inside of the S&Ps to the downside to only turn back around on Tuesday, rally back to the 2610, sell back off. Your hopes and dreams are crushed on Wednesday when you think the bottom is going to fall out, until we whip right back around. Again, this is still on Wednesday, coming into Thursday in the overnight trade over here. Thursday is the only day it was, well, kind of mellow. Yeah, until Thursday, afternoon, when we had a little bit of a tweet incident revolving around trade war. The S&P futures dropped out. I gotta tell you, I really thought, this was probably going to be somewhere around the bottom, and that bottom, that was the that 26 level in the S&Ps. But people, towards the end of the trading day on Friday, we just went for it to the downside. And again, I don't usually go through in that much detail, but when I say we went for it this week, the S&Ps are just bouncing back and forth in these tranches. And for those of you, again, if you don't tune in on a day-to-day basis, the levels, and we now have a name for these levels. We're calling them actual gravity points. The levels that I have kind of depicted on the screen are kind of the tranches that we're bouncing back and forth from in the S&Ps, and I always like to label them. So on top over here we have 2682. Dead in the middle is our 26. Okay, 26, and to the downside you're looking at 2575. Those are the three primary levels that have been in play, and they've been in play not just this week. They've been in play for a pretty extensive period of time. How these levels are actually pulled out is, well, exhaustive looking at 1 minute charts, examining volume. The points are basically based, and again, I'm calling these kind of gravity points because the marketplace, do not think of them as support and resistance. Okay, the marketplace is actually drawn specifically to the levels, hence why we call them kind of gravity points. These levels are discerned by looking at intraday trade, and with that intraday trade, I'll examine all the way down to 1 minute volume in the S&P futures. Now, why do I do that? Large hedging firms, okay? And when I say a hedging firm, it doesn't necessarily mean a hedge fund, but very large derivatives firms, okay? Banks, when they're mitigating risk, market making firms, they mitigate risk in a very, simple manner. They hedge, all right, with dynamics of the marketplace. And I'll just give you a quick example here. If the S&Ps in this example are selling off, the firm would actually sell S&P futures in to the selling, and that's actually why we get most of the dynamics we do in the market. In fact, there's a name for this. Most people, years ago would call it dynamic hedging. Dynamic hedging is hedging with the dynamics of the market, and it's also responsible for a lot of the wild rallies you see, a lot of the wild sell-offs. Okay, but in the midst of the dynamic hedging, you get these seams. All right, and what a seam happens to be, that's kind of what we're calling these gravity points now. That seam is kind of where two different trading firms or hundreds of different trading firms, their risk is happy at that particular level. So when I say the risk is happy, that's when they'll be, oh, stop, we don't have to hedge here because this leaves us, for example, with a delta of almost zero. That's a pretty wild concept for people just to acquire in a few moments. Nevertheless, it is responsible for what we call these gravity points. So when we actually launch off one of the gravity points, very likely we'll come right down to another gravity point. What's interesting about it, though, is when you get trapped between two separate gravity points and you end up pretty much smack in the middle of it, and it makes perfect sense. You have some firms that have heavy risk in and around the 26, other firms that have, risk in and around 25.75, and we end up dead in the middle. Why? Because they're fighting back and forth. So, hey, that's what makes a market fair and two-sided. You have to realize this is not just one or two firms. This is thousands and thousands and thousands of derivatives firms betting back and forth amongst billions and billions of dollars. So this week just really turned into, and the only way you can describe it is absolute manic trade. We're up, we're down, we're happy, we're not happy. And here's what I want you guys to think about kind of moving forward. I'm going to cruise over to the SPX, albeit briefly. And the reason we're going to go to the SPX is it's time to talk a little bit about expected move, and we're going to look at some of the opportunities. So last week, this expected move was equivalent, all right, to about $62. And yet we stayed inside of it, all right? So as the week kind of progressed, I'll zoom back into this. As the week kind of progressed, things got a little wild. And during the course of the week, we actually did crack the downside, but on both Monday, Tuesday, and Wednesday, all three of them, in fact, we held the edge of the expected move. We bounced huge, we sold off, we laughed, we cried, but we did end up inside of the expected move. I'll come back to that in just a moment. Now, in the week moving forward, right, that's this coming week, we are actually looking now at almost a $69 expected move. So the expected move has expanded. Now think about that, if you will. You just came off of a fairly manic week, all right, with about a $62 expected move. Now you're facing an even larger expected move, which kind of makes sense. Why? The week is so manic that they're actually pricing options with heavier amounts of risk in the next week. Not to mention, what's going to start to come into scope. This week, you're going to hear maybe a little bit less about the trade war. Well, in the beginning of the week, they'll still be talking about trade war. Maybe a little less about like interest rates. But what's going to come into scope this week is you're going to get many of the financials that are starting to report. So by the end of the week, all we're going to hear about is like JP Morgan, Bank of America be the following Monday. But people, we're coming into earnings. We are starting to come into earnings. Now, the banks, they don't create a huge amount of volatility around earnings. I think the best way to look at the banks and kind of figure out, what's the volatility going to be in terms of the banks? I think the best way to look at that is just cruise over to the XLF and look at the option chain. It's up to about a 30% implied volatility for the next 6 days. But the XLF, we're looking at almost a $1 move in the XLF, which is on a percentage basis. Hey, put on your big boy pants, because you're talking about what? 3, 4, 5% moves moving forward from the XLF. So again, earnings are going to start to play a central role inside of markets in just the next couple of days. Again, the rhetoric is going to shift from trade war. It's going to shift from Jerome Powell, and we're going to start to focus on, again, of course, earnings. Kicks off with the banks, but have no fear. The Netflix, the Apples, the Facebooks, the Googles, they're right around the corner. Again, we're a couple of weeks away now from party time and technology in terms of earnings. All right, let's cruise back and start to look a little bit of what we term correlation. So here's where I was saying individual stocks right now don't matter that much. Just a moment ago, I mentioned, let's look at, the earnings. But the reality is simply that what matters right now, this is the S&P 100. So yeah, I can throw up the S&P 500. Somebody inevitably sends me an email. Why didn't you use the S&P 500? Because I can't fit it all on the screen. All right. It's just too much to fit on a screen. But this is what I often term full-blown correlation. It doesn't get uglier than that. And when you start kind of cruising through this, most things are down on a percentage basis with what the S&Ps specifically are doing. So when the markets start to get a little bit manic, that's when you have to back away. You're like, well, my Fibonacci says that Apple should move here. You got to get away from it. All right. And I'm not trying to poke fun at Fibonacci's. Well, all right. I am trying to poke a little bit fun at Fibonacci's, but I'm not trying to poke fun specifically at technicals. What I am saying, though, is the only technicals that really I would think come into play are related to the broader indices, because in the heat of battle, nobody cares about the individual products and everybody focuses on, all right, the index products themselves. So that's what that statement, correlation kind of grips hold, means. And you're going to hear me say it a lot. That's what matters right now in today's marketplace. All right, switching gears here. So again, we had a fairly wild week, and there was one thing that was just really bothering me throughout the course of the week, and I'm going to show you exactly that. So the expected move inside of the SPX, we were just kind of delineating a moment ago, was about $62. It's pricing even closer to $69 this next week. But the thing that I'm really bothered by, it's not so much, the expected moves over here. And again, this coming week, we have about a $68, almost $69 expected move. The thing that really resonates with me, like go take a look at the VIX, right? But the VIX is measuring implied volatility, okay, some 30 days out in time. Now, one of the things, though, that just grabs me is, you got the S&Ps at one point in the trading day, and let's go look at the VIX in this case. And I'm not big into technicals, but you got the S&Ps at one point in the trading day, they're down 3%. And the VIX, I just felt like it's yawning. Oh, maybe I'll get around to actually waking up and moving. It's insane. But that doesn't necessarily mean, it doesn't mean that, options are cheap. I should definitely buy options. So I looked into some of the mathematics, as I was saying a moment ago behind this. I want to show you something really interesting. So some people are looking at this and saying, well, the markets are capable of moving a lot right now. Yeah, they are. Okay, they are capable of moving a lot. But if you looked back again at the expected moves, okay, the last 2 weeks we stayed inside of the expected move. So they're starting to expand out the expected move. So what should you do? Should you be a buyer of options premium, or should you be a seller of options premium? And this is not easy stuff to be able to figure out. Therein lies an interesting answer in here. Okay. First of all, I am a little bit nervous right now of selling options premium. And I'll go back over to the spiders for just a moment. And I'm going to tell you why I'm a little nervous selling options premium. Quite simply put, I just saw yesterday the S&P is down 3% and the VIX laughed at it. That's one of the reasons I'm nervous selling options premium. And I've talked about this week in and week out, that I believe a fairly extraordinary volatility shock will hit markets. So vicious, so ugly that people won't want to sell premium. And the irony is that's when it's going to be a good time to sell premium. But in the near term, yes, I think you can sell some premium, but with a very light hand, really limited contract size. And I would not sell premium, okay, in these shorter duration expirations. You're going to get run over. The shorter duration expirations, anything within 30 days, okay, the gamma is just too high. You are going to get smoked if the market makes a big move. So you're going to have to sell duration premium. That's something that we do explain quite in depth here at TheoTrade. Duration premium, go a little further out in time to avoid the gamma risk. Now, I just said, well, I don't think we should be, selling premium within this 30-day window. Does that mean you should buy premium? Absolutely not. One of the things I kept looking at, I'm like, can I buy, just think about this. Can I just buy a straddle? Can I buy a straddle? All right. That's 13 days out. 13 days out. And the thing is trading for $8.35. Now, can the market move that much? Yeah, maybe. But the issue that you have with buying the straddle is simply that why buy the straddle? Well, the straddle, for the most part, we go up, we go down, you're going to make money. I don't need no stinking risk graph. You go up, you go down, you're going to make money in the straddle. That's the reasoning for buying the straddle. But here's the reality. It seems so easy, right? If we go up, we make money. If we go down, we make money. The problem is if we go up, they're going to crush this volatility. I just looked at some of the recent moves and they just smoked the volatility right out of the calls. The calls, they would have to go intrinsically worth $8.35 just to be able to get your money back. So for the most part, to even make money on a straddle, you would have to have what? $8.35 move up in the spiders. Legitimately, to even make money on it after commissions and everything, you're going to need a $10 move. That's a 100-point move in the S&Ps. Do you think it's worth risking $8.35 to be able to make what? $1.50? Maybe, if you're lucky. It's insane. You can't make money on the straddle. Now, could you make money on the put? Yeah, maybe, but then why buy the call and the put? You just buy a put and then pray at that point? It doesn't work. Okay? So buying the straddle just isn't working, but selling it is also just too high of risk right now because the marketplace could crash. So whatever you're going to do it with defined risk. But I'm just poking a hole in the idea of trying to buy premium in the short term. Now, here's something a little bit different. Inside of the spiders, we are afforded the ability now to trade with 3 expirations per week. Now, this is something completely different. We've got an expiration for what? 2 days, for 4 days. This is a Monday, a Wednesday, and a Friday expiration. There, we do have some edge. And I'll tell you what the edge is. The moves are so vicious on an intraday basis that these options, okay, are wonderful to trade. You have to recognize what I'm saying here. This is something I've been talking about day in and day out on TheoTrade. Here's an option for $1.50. What's the most? If I bought this option, it's a put. The most I could possibly lose on it is $1.50. Yet the expected move for the trading day is what? About $3.60. Think about the bang for the buck you have in this, okay? You can lose $3.50, but if the market, this is a put, if the market were to tank, the market can tank as much as $3.60. Why wouldn't you want to risk $1.50? This option is pretty much at the money. This thing can go in the money, okay, by the amount of what? $3 and some 60 cents. So, all right. So you have a case in point where you can make more than you can lose. The gamma in these trades is spectacular lately. So on an intraday basis, buying options can be very, very effective. Now, you didn't hear me say buying a straddle. Buying the put is far more effective than buying the call. I'm not trying to rip on you for possibly being bullish. I don't care. You want to be bullish, but buying the call is not going to work, because if you buy the call and the market does rally, they're going to suck the implied volatility out of the calls. So you're kind of a little bit, limited as to what you can do right now on an intraday basis. One of the things I've been doing on a day-to-day basis, I've been buying puts, and, we hit it out of the ballpark. All right. On Monday, we hit it out of the ballpark. On Friday, I got run over on Wednesday doing the exact same thing. All in all, excellent trading week. So these are a lot of things to think about. Now, the big and the $1 million question, of course, and I'm going to leave you with this, is what does everybody think about the market? What do I think about the market kind of moving forward? As I said, earnings are going to play kind of a central role at this point in time. And I'm actually going to back up the chart a little bit more for you here momentarily, just give you a little bit more perspective. But at this point in time, let's go to a 4-hour. We'll even look back at like the last 180 days on a 4-hour. We're most likely going to crack the bottom level that we have on the screen, which is 25.75. And from there, we have some open air to the downside. So I think it's reasonable to assume that we are going to crack some levels to the downside. Now, that doesn't mean immediately, okay? I think you should still, all right, recognize that volatility is going to be here to stay, and here to stay for quite some time. But we're starting to open up the possibility again of cracking the downside. And if we do crack through this 25.75, that's when I think volatility will really start to pump up, and it might give us our first decent opportunity at selling some options premium. Again, the first decent opportunity of selling options premium is when we break loose of this 25.75. And no question really in my mind, we're likely not only to retest some of the lows of February, but possibly crack through them. Now, that's not necessarily just this week. I want to make that clear. Like, I don't see us cracking apart and hitting 2,500 this week. but there's definitely more downside that is capable in this market. Just recognize as a trader, be defined risk right now. Trade small. You're getting wild intraday movement. If anybody tells you they know exactly where this marketplace is heading, they're out of their minds. We're one tweet away. We're a tweet away from moving up or down 100 handles in the S&Ps. You know, the markets love you, they hate you, but soon again, we're going to start focusing on earnings. And when it comes to it, the financials, I'm not exactly sure how they may have done in this most recent quarter. Their trading revenues might be good, but some of these firms could be on the wrong side of some of those trades. With that, I want to thank everybody for joining us at TheoTrade and this weekend update. Have a great weekend, everybody. Bye-bye.